Let's start with the rationale. If you see growth companies in US, you realize that based on this table done by Compound Investor, many growth companies have been hit hard in 2021, some of them losing as much as 75%. And on the list, you'll see some familiar names. Zoom, for example, is one. Year to date, Zoom has lost 47% when they did a 4x in 2020. And if you see from top to bottom for this year, you realize that Zoom has lost 65.72%. As of now, Zoom's price earnings ratio is still quite high at 50 times. On the other hand, household names like Spotify has also lost 28% in 2021. That's after doubling its value in 2020. DocuSign, which is something that I also use for work, has also doubled in terms of share value in 2020, but lost 34% in terms of value for 2021. Recently, it's also seen a big plunge in terms of share price. So my thesis is for 2022, growth companies need to be profitable. The market may not be favoring growth at any cost. That's why today I've curated two names to suggest to you that are listed in Singapore. These two stocks have done fantastically over the last 5 years. Without giving them away, let me show you the first one in terms of 5-year chart. You realize that it's done a 624% gain in 5 years, correct? The second one, even more spectacular, 3,621%, which is 36 times in 5 years. In today's tutorial, I'll give you a full breakdown of their business operations, the various business segments that they are in. And if you're keen to find out more on their growth story, continue watching on. Hi guys, welcome back. Without further ado, let me introduce to you the first company, who is Frencken. Frencken is big in mechatronics engineering and high precision engineering plastics. They actually make machines for some of their industry customers, and they include ASML, GE Healthcare, Bosch, as well as Bentley. And if you see their business segment breakdown, you realize that they are into medical field, semiconductor field, analytical field, and factory automation. But if I flash up the chart again, you realize that their share price has tumbled quite significantly, correct, since October 2021. So what is the reason for it? This chart explains. As of third quarter 2021, they are still highly profitable, making 14 million for the quarter. And for a 9-month breakdown, they are on track to do a new record year. However, the key concern is that material costs and freight costs has actually caused margins to drop, depicted in the green line over there, and third quarter's profits were actually lower than second quarter. So when it comes to a growth company, analysts and market is always looking out for any slowdown in terms of the growth momentum. However, analysts are still pricing in healthy growth for 2022 and beyond. This is mentioned by UOB Kay Hian. Their channel checks have suggested healthy pricing environment for the components manufactured by Frencken and indicate healthy demand from their customers. Their projection for the full year 2022 is a 10% increment in terms of net profit for the year. Now, Frencken is involved in many high growth sectors such as 5G, IoT, and AI development. It's quite diversified, and if we see this breakdown over here, you realize that 40% of sales comes from semiconductor industry. If semiconductor industry slows, not a big problem because they're also involved in industrial automation, 16%, analytical and medical field, 29%, as well as 11% in automotive segment. In terms of valuation, this recent correction for Frencken Group might be good news, especially if you want to become a long-term investor in this company. Right now, it's trending below the 17 times price earnings ratio, and this is slightly below the upper valuation for a 3-year average. In addition, its directors have been buying big amounts in December 2021, and the average share price I can share with you is around $2 per share. So insider buying is definitely good news. At least they have skin in the game, they have conviction on their own business. And as always, insiders know the trend moving forward. Maybe this margin drop is just temporary and they foresee strong prospects for the company moving ahead. So if you're a fan of Frencken or if you have any questions, leave in the comment sections below and we'll dive on to the second growth company to talk about today. Today's second growth company, which has done 36 times in terms of share price performance for the last 5 years, is none other than AEM Holdings. Now before we get there, invite you to smash the like button because it's taken our team hours to prepare this presentation for you. And again, if you like content on Singapore stocks, smash on the subscribe button. So AEM has seen spectacular share price growth, correct? And its main business is it manufactures equipment for the semiconductor industry. They are very focused on semicon sector, unlike Frencken, which is previously mentioned. And for semicon sector, you realize that there is big industry tailwind. And if we compare them across some of the biggest semicon names such as Taiwan Semiconductor, TSMC, AMD, as well as NVIDIA, you realize that AEM has actually outperformed them massively. Now, many people say that Singapore market is boring and that it's too small. So it's not necessarily true. AEM was once a microcap, but right now it's 1.6 billion worth already. And the question you may have is, what actually happened that caused the business grow so tremendously? If you see this chart over here, you realize that AEM previously, it used to be pretty loss-making. Profits were erratic and they didn't have any market leadership. AEM has actually seen a new management come in 2017, and with that has actually changed the company's fortunes tremendously. And this growth has shown no sign of slowing year on year. It did a 9x in terms of profitability for 2017 itself. And what actually happened is that back then, Mr. Lok Wai San, who manages a private equity, actually bought into the company and did this whole turnaround. Subsequently, he has acquired many small semiconductor industry players and solidified AEM as a leading player to serve the semiconductor industry. And this is actually an interesting quote from him. He's mentioned before that they've been told countless times that it's virtually impossible for a small Singapore company to take the global stage. And after their blood, sweat and tears, AEM today is a homegrown multinational. I think that's something very commendable. Not many small companies in Singapore have actually branched overseas and grew at such a pace. So again, fantastic achievement, and if you agree, smash on like button too. So AEM recently has actually raked in an endorsement from Temasek Holdings. You know, Temasek used to have this Midas touch, but of course lately Temasek's acquisitions haven't been that spectacular. AEM actually raised $103.1 million in a private equity placement. So this actually came in August 2021, and you can see over here that after that news, share price has actually surged up quite a bit. But before we talk too much about the share price surge recently, we should also look back as to why the share price stalled, especially in 2020. That's because its key customer Intel was actually going through some changes. It had a new CEO, and it actually stated different outlook in terms of its capital expenditure. Many analysts who track AEM actually look for Intel's capital expenditure trend as a sign of how much potential revenue that AEM can deliver. But having said that, AEM has been trying to diversify its customer base for the last few years. And with acquisitions such as the one that they have done with CEI, AEM now has different services and can pitch to its own customers with a more comprehensive suite of solutions. Using the price earnings chart, AEM looks to be slightly expensive as of current moment. The red dotted line above is the upper valuation, but right now it's surged way past it and currently has a price earnings ratio of more than 20 times. But the key factor for AEM is that if earnings start to surge up again, this increment of its price earnings is actually justifiable. So which of these two companies is your preferred choice? Leave in the comment sections, I'll be keen to hear from you also. And as always, I have a previous video to introduce to you. This has been my early pick for top growth company for 2022. If you haven't seen it, check it out, it's going to surprise you. With that, I'll sign up from here and see you there too. Take care and goodbye.